Hey everyone, today we're diving into a powerhouse of an ETF, the Goldman Sachs NASDAQ 100 Core Premium Income ETF, ticker symbol GPIQ. This gem is managed by Goldman Sachs Asset Management and currently yields an impressive 11% annually. And what's even better, it pays monthly, offers core equity exposure with low volatility, and provides a diversified source of income that can be fit beautifully into your portfolio. Before we get into details, let me share why this ETF gets me so excited. Back when I was grinding away in my career, I was laser focused on finding investments that didn't just grow but paid me to hold them. I wanted financial freedom, not just a bigger number in my brokerage account. That's why funds like GPIQ are game changers. They're the cornerstone of how I retired at 41 years old, and I'm thrilled to break this down for you. If you're new here, my name is Adam, and I retired in 2024 at the age of 41 years old. My retirement is built on a unique three-part approach: the multi-bagger for asset accumulation and appreciation, the dividend machine for high-yield, consistent distributions to cover your bills, and the options income strategy to accelerate passive income with covered calls and cash-secured puts to fund your retirement in style. If you want to learn how I did it, stick around and you'll see exactly how to retire early like I did. Now, let's jump right into it. I recently added this ETF to my portfolio. I own about $30,000 of this fund, and it's a brand new buy for me that I bought last week. So I haven't received any dividends yet, but I am excited to receive around $275 at the next payment. And I'm excited to see this income stream start flowing in. Let me break down how GPIQ works. The ETF tracks the same stocks as the NASDAQ 100 index, meaning it holds all the heavy hitters like Apple, 8.9%, Microsoft, 7.8%, NVIDIA, 7.8%, Amazon, 5.6%, Meta 3.4%, as shown in its top 10 holdings chart as of March 19, 2025. But Goldman Sachs doesn't just sit on these stocks like a typical index fund. They add a dynamic option strategy to generate consistent income. The fund allocates about 80% of its assets to equities, while the remaining 20% is used to implement a covered call strategy, balancing income generation with high growth potential. Here's the nitty-gritty of their approach. Straight from the perspective, GPIQ uses a dynamic override strategy where it sells call options on a portion of the market value of its equity holdings. Under normal circumstances, the override level, basically the ratio of the national value of the call option sold to the market value of the equity investment, ranges between 25% and 75% of the portfolio's equity value. This strategy caps gains in a strongly bullish market because if the stock rises above the strike price of the covered call option, the fund might have to sell at that price, missing out on future upside. However, the premium collecting from selling these options can lead to outperformance in other scenarios like a flat, modestly rising or declining market. In fact, this is exactly why GPIQ has been leading the NASDAQ 100 in 2025. When the market is unchanged, falling, or only slightly up, the premiums can outpace the index appreciation, giving GPIQ an edge. For example, year to date, the NASDAQ 100 QQQ is down 6.25%, while GPIQ is down 7.44%, not counting the dividends. But when you factor in for dividends, GPIQ's total return brings that loss down to just 4.98%, showing how the income from the premiums help cushion the downside in a sharply rising market. Though, where the index gains exceed the premiums, GPIQ might lag a portfolio within this option strategy. So while the distributions remain steady, the income funding them varies based on the market conditions and how the management team structures the options trade. Unfortunately, we don't get the detailed specifics on each options trade, but the covered call method is relatively low risk and Goldman Sachs experienced teams know what they're doing. So, for newbies out there, what exactly is a covered call? Imagine you own a stock and you agree to sell it at a set price if it hits that level by a certain date. You get paid a premium upfront for taking that deal. Goldman Sachs does this with the NASDAQ 100 stocks, carefully selecting strike prices to optimize income while maintaining prospects for capital appreciation. It's like renting out your portfolio for extra cash. And GPIC does this systematically to deliver monthly distributions. Now let's talk about those distributions. They are as steady as a rock. Looking at the payout history, GPIC has been paying between the high 30 cents and the low 40 cents per share pretty consistently monthly, ranging from 0.375 to 0.4285 over the past year, with the latest dividend of 0.415 per share paid on March 7, 2025. That's systemic income you can count on, derived from a combination of options premium and equity dividends. We're not talking about some shaky dividend that might get cut. This is a reliable income designed to be consistent. Here's where it gets even more interesting: the tax structure. Unlike some of the other ETFs that I mentioned on this channel, like SPY-I and QQQI, that sell options against futures, GPIC does not sell options against futures. If you missed those ETF reviews, just click on the video up above where I go over these massive 12 and 14% dividend payers. According to a recent 19A1 notice from Goldman Sachs dated January 2nd, 2025, 100% of GPIC's distributions are classified as a return of capital. This means you don't pay taxes upfront on these distributions. Instead, they reduce your cost basis, and when your initial investment is returned, it's taxed as long-term capital gains, which can be more tax efficient depending on your tax bracket. The structure can help you keep more money compared to other ETFs where the distributions are taxed entirely as ordinary income, which can be hit at a 37% tax bracket for high earners and close to 50% when you factor in state taxes. Now let's talk about performance, because GPIC really shines here. The fund launched on October 24th, 2023, and is up a massive 35.49% since inception. But let's actually compare it to the S&P 500. Over the past year, GPIC is down 2%, while the S&P 500 is actually up 8.39%. Year to date, GPIC is actually down 7.44%, while the S&P 500 is only down 3.43%. However, this is not taking into account GPIC's 11% in dividends, so it actually outperforms the S&P 500 by a wide margin, making it a fantastic choice for both income and growth. Even when compared to the NASDAQ 100 QQQ, which is the underlining for GPIC, it has performed on a total return basis this year and since July 2024, thanks to the income generated from its option strategy. Among covered calls, the NASDAQ 100 ETFs, GPIC stands out because it is designed to offer the most appreciation in a bull market, while other ETFs like QQQI, for example, or XYLD don't have much NAV appreciation or have NAV depreciation. GPIC actually shines in bull markets and captures a lot more appreciation than its covered call QQQ counterparties. And this is due to its dynamic option strategy. You're getting income, some upside potential, and a buffer during those scary market dips for downside protection. Now let's talk about the management. Goldman Sachs Asset Management isn't some passive shop. It's a household name. It doesn't just collect fees. They're actively managing this strategy every single day, and Goldman Sachs oversees over $2.8 trillion in assets at the end of 2023. And they bring their expertise to GPIC, aiming for consistent monthly distributions, lower volatility, and a diversifying source of income with lower correlation to traditional income sources. The management fee is a reasonable 0.35%. That's $35 per year on a $10,000 investment. When you're getting 11% yield plus tax benefits, that's a fee that is absolutely negligible, and it's already baked into the return, so you don't actually feel it. GPIC itself has $465 million in assets under management, which is respectable, but it does lag behind some of its competitors. Still, this ETF is a strong contender in the covered call space, especially for those who want a balance of income and growth. So how does this fit into real life? Picture this. You got $100K to invest. You put $50K in GPIQ, and you're looking at $5,500 a year. That's about $458 a month of passive income. Pair that with a growth ETF and some individual stocks, and you've got a solid mix of income, upside, and tax efficiency. That's my part 2 of retirement, the dividend machine in action. Now let's talk about the risks, because no investment is without them. While GPIC's dividend has been steady at around 11%, there's no guarantee that it will stay that way. As its prospective notes, while the fund aims to provide monthly distributions, there's no assurances that they will always be paid or remain at a stable rate. The NASDAQ 100 can be volatile. Just pull up any chart. That's a big move for an income-focused investment, and it's highlighted the risk of capital loss and potentially smaller dividends if market conditions worsen. In other words, if there's a huge downturn over a long period of time, it's possible that the dividends that GPIQ gives you is going to go down. If that is or not going to happen, I can't tell you one way or the other, but I feel confident in this investment either way. If the market crashes hard, an options premium might shrink, and the NAV could also take a hit. But that's where Goldman Sachs active managements come in. They're not locked into bad trades, and they can adjust dynamically to market conditions. That's the whole thing about dynamic options. It's not set in stones, and they have a lot of leeway to take advantage of current conditions, one way or the other. So what's my take? I think GPIC is a buyer under current conditions. It's outperformed the QQQ on a total return basis this year and since July 2024. Thanks to the income from its option strategy, the steady 11% dividend yield is incredibly attractive. And with a low expense ratio of 0.35% for an actively managed ETF, it's a great deal. I expect the NASDAQ 100 to remain largely range-bound this year, which plays right into GPIC's strength. This options premium will keep the income flowing even if the market does not move much. Here's a quick synapse of what you're getting with GPIC. You're getting an 11% annual yield paid monthly, tax-efficient income with 100% of return of capital, core equity exposure with lower volatility, some downside protection and upside potential, active management by Goldman Sachs expert, a diversifying source of income. This is the perfect combination for anybody looking for a reliable income without taking crazy risks. Of all the covered NASDAQ 100 ETFs, GPIC offers the best balance of appreciation in a bull market, downside protection, and consistent dividends. Let me be clear, this is not some get-rich-quick scheme. This is a serious investment strategy for people who want steady, reliable income, the kind of income that helps thousands of investors sleep better at night. If you're hungry for another high-yield play, let me point you to a different ETF that's catching my eye, a 14% dividend ETF betting on American bond market. It's a fantastic option for those looking to diversify into fixed income securities while chasing juicy yields. See you later. Peace.